as the conflict between Russia and Ukraine advances into yet another month, its effects continue to ripple across the world. It now poses another major threat to the global economy, causing a global funding slowdown. Well, the experts say that this time around, Africa's tech space may be immune to that slowdown, even though supply chains have been disrupted and a food security crisis has worsened on the continent. Researchers say that even as whole venture funding is slowing down in the US, Asia, and Latin America, big venture capital firms are now adjusting their strategies to focus on early stage startups. And African startups are seeing some of that redirected capital. According to a report by the African Private Equity and Venture Capital Association, in 2021 alone, African startups already raised more than the preceding 7 years combined, as we saw startups draw a record $5.2 billion in venture capital funding. Well, let's now discuss this all further with Flourish Ventures, an evergreen fund investing in fintech entrepreneurs across the globe. We're now joined by Efayomi Carr. He is the principal at Flourish Ventures. Great to have you with us on the show today, Mr. Carr. Now, as we just mentioned, venture funding is slowing down globally, in specifically the US, Asia, and of course Latin America. Should African startups be worried as well?
Yeah, thank you for having me. I think it's important to note that the slowdown is tied to the macro landscape. As you mentioned, the stock market recently plunged. We have war in Ukraine, which has led to disrupted supply chains, and the COVID outbreak continues to curtail markets, especially in countries like China. As Africa is not insulated from this. I think as these macro markets change, it means that the large checks and a lot of the capital sources are also going to shift their investment strategies. So what this means is for later stage companies in particular, some of the funding that was initially coming, especially from some of these markets that are most adversely affected by the macro landscape, that funding will dry up. And so I think for many African startups, the emphasis will be on how do we maintain strong fundamentals in order to insulate ourselves when funding is less certain.
Well, on that note then, what do you think, or what are your thoughts on what people say when they say some VCs are now turning their focus to early stage startups? Are we going to see them now adjusting their strategies drastically?
Yeah, it's interesting. The later stage companies are going to be most closely tied to the public markets. And so we saw in the last 2 weeks, the stock market, the NASDAQ in particular, which is related to tech companies, has taken one of the largest dips it's had in the last 15 years. And so later stage companies that are close to going public, close to going to an IPO, are going to be more adversely affected, which means that for many of the investors who have the opportunity to invest in both early and late stage companies, they need some place to deploy their capital. Last year, 2021, was a landmark year for venture. There was the most funds that had ever been raised. And there remains $250 billion in funds that were raised last year that is yet to be deployed. Because of the public markets being adversely affected, that capital has to go somewhere. And honestly, and while there are many, many good companies out there, because later stage companies are not going to get that funding, it will likely be tied to early stage companies that have solid fundamentals. So they'll look, instead of growth, many of these investors are focusing on profitability and sustainability.
Quite right. And you said the capital has to go somewhere, but a focus is on profitability and sustainability. But there is a lot of debate around the fact that startup valuations in African startups, that's a huge issue. And one person mentioned the fact that there's a lot of recency bias. Now, he said the scale of valuation changes, it changes depending on how optimistic people are about the long term. Now, given the current environment, the Ukraine crisis, we're recovering from the pandemic, some are asking, are there elephants in the room when we talk about GDP growth? And are we going to see VCs sort of pricing in the risks or these risks going forward?
Yeah, absolutely. I think I mentioned last year was a landmark year for venture capital, as this asset class saw the most funding raised, but also by far the most funding deployed in its history in the calendar year of 2021. What that meant was you had a lot of money being raised that was chasing the same amount of deals, a lot of supply in the system of capital and less demand. And so there was a inflation of valuations in 2021. I think what we're seeing now is a compression of that inflation, meaning the fundamentals of businesses have not changed. That's actually stayed the same. What has changed is there's been a compression in multiples. Companies that were valued at 5 or 10x revenue are now being valued at 2 or 5x revenue. That does not affect the overall landscape. It means that there are very, very solid companies that have really high prospects in the future that still remain. However, it means that venture capital firms and investors more generally will be less willing to spend over and above as they were last year because there's just a dearth of capital in the market.
Well, currently, African startups also depend quite a lot on foreign capital. How much can they really depend on local investors going forward in order to provide that funding that they need to grow going forward?
As you mentioned at the start of this, African firms raised $5 billion in 2021. That's 3 times more than they raised in 2020 alone. Generally speaking, there was a lot of attention and a lot of capital coming into Africa from foreign investors. And that happened particularly at the later stage for many reasons, but largely because many of the later stage funds, they exist in other markets in US and Asia, because Africa traditionally has not had as many companies reach that stage. However, what changed last year is as this capital came at the later stage, it actually bolstered the local markets. A lot of angel networks and early seed and Series A investors in local markets began to raise their own funds because they were able to identify a lot of companies, and they knew that at the later stage, there would be capital and exit opportunities for them. And so I think this downturn, all it does is reiterate and demonstrate the importance of local capital. Local investors will not leave when markets turn. In fact, local investors will double down because they understand the value of the companies that they're supporting. And so I think that right now, while we're seeing some of the capital, from especially foreign capital, leave at some of the later stage companies, it actually reinforces how important local capital is. And it shows the really positive and optimistic prospects for local investors. I think we'll continue to see that throughout this year.